and I thank the gentleman from Texas for holding this special order tonight. Mr. Speaker, birthdays are usually a cause of celebration. But this week we mark 5 years, 5-year birthday, since one of the most overreaching and damaging laws in recent memory, with a heavy hand on our economy. Now, when the Democrat majority passed Dodd-Frank, there were 3 big promises they made about this legislation. First, that the legislation would end too big to fail. Second, that the legislation would protect consumers. And third, that Dodd-Frank would make our economy more competitive. So why don't we take a look at each one of those one by one and see how they worked out so far. Promise number 1, Dodd-Frank will end too big to fail. Well, first, Dodd-Frank really did it end too big to fail? Well, for starters, by just about every measure, the biggest banks today are even bigger than they were before the financial crisis, while community banks and other small lenders continue to be shut out and shut down around the country. In fact, according to recent statistics, the 5 largest banks in the nation now control roughly half of all the assets in our banking system. To put that into another perspective, that means that outside of these institutions, it takes collectively the collective assets of over 6,000 banks in order to equal the amount of assets held by the 5 largest banks. Moreover, the so-called resolution authority, included in Title II of Dodd-Frank, is not, as our former colleague Barney Frank put it, a death panel of the banks. It is, in fact, instead a mechanism for future bailouts, enshrined now into the law. Now, this is not just a case of baseless accusations. One need only look at the actual text of Dodd-Frank to understand how it allows for big banks to be bailed out. Who? By you, the American taxpayer. For example, Dodd-Frank gives the FDIC, the Federal Deposit Insurance Corporation, the authority to do 2 things. First, purchase the debt from creditors of a failing institution at par or even above par. And 2, pay any obligation of an institution that it believes are necessary and appropriate during that time of crisis. So Dodd-Frank, of course, also created the so-called FSOC. What is that? That's the Financial Stability Oversight Council, which during its current existence has done virtually nothing to enhance the stability of the financial market. In fact, if you look at it, through its systemically important designation of institutions, FSOC has gone in the other direction. It has put taxpayers now on the hook not just for banks and bank bailouts, but the potential bailout of non-bank institutions as well. So a law that has made the big banks bigger, give regulators such a vast expansion of authority, and put taxpayers now at so much risk cannot conceivably be called having to ended too big to fail. And it's not just those on our side of the aisle who are skeptical of Dodd-Frank's claims. Here's 2 examples. The GAO in a January 2013 report concluded, quote, there is no clear consensus on the extent to which, if at all, the Dodd-Frank Act will help reduce the probability or severity of future crises. And Cornelius Hurley, a former senior official at the Fed Reserve, stated recently, quote, if the whole purpose of Dodd-Frank was to eliminate the concept of too big to fail, and you judge it by that standard, well, then it's a failure. So by any objective measure, it is clear, I think, that they failed at point number 1 and promise number 1. So let's look now at promise number 2. Dodd-Frank will protect consumers. How has it protected consumers? Well, on that matter, it depends in large part on what you mean by consumer protection. You see, the drafters of Dodd-Frank and many of my colleagues on the other side of the aisle believe that consumer protection involves bureaucratic control over the entire credit market, which gives a handful of individuals here right in Washington, D.C., the bureaucrats, the ability to decide what kind of mortgage you want, what kind of credit card you're going to get, the kind of student loan Americans should have access to, and so on. Hence, the creation of the unaccountable CFPB and the incredible amount of authority now that they have been given is given to a single agency, or actually to a single dictator there, if you will. But real consumer protection doesn't involve unelected and unaccountable bureaucrats making decisions on behalf of you, the American citizen. No. Real consumer protection involves ensuring competitive credit markets and empowering the consumer to make their own choices based off of well-disclosed information in the marketplace. And so by this measure, the Dodd-Frank and the CFPB, they have again failed miserably. Take, for example, the CFPB's qualified mortgage rule, which became effective just last year. According to a study from the Federal Reserve's own Federal Reserve Board, roughly 1/4 of Americans right now have obtained a mortgage in 2010 would not have qualified for that mortgage that they did get under the QM rule, increasing the likelihood then that millions of Americans will find it harder in the future to actually qualify for a mortgage. Moreover, the effect of QM is even more pronounced on certain segments of the economy, such as minority borrowers. The same Federal Reserve study noted that about 1/3 of both African Americans and Hispanic borrowers would have been ineligible. They could not have gotten a mortgage under the QM loan. And many of the Bureau's initiatives regarding credit cards and other loans will ultimately have the same effect of making it neither almost impossible or too expensive for individuals who are starting businesses to draw a line of credit. So it is clear that on promise number 2 of 3, that Dodd-Franks is protecting consumers and is in fact harming consumers and making it harder for them through all this red tape. So next and finally, promise number 3, Dodd-Franks will make our economy more competitive, they said. That third promise will make our economy more competitive clearly has not come true. And in fact, Dodd-Franks is a direct cause of the economic struggle that millions of Americans continue to face today. Just take a look for a minute at the sheer breadth of regulation that has come out of Dodd-Franks. The law provides so much regulation that it is a burden on the economy. The law firm of Davis Polk performed a public service back in 2013 when it estimated at the time that for every 1 word of text in Dodd-Franks, 42 words of regulations have been produced. And since that time, the number has even grown. So how can our economy possibly be more competitive today when such a huge amount of complex and burdensome regulations have been implemented over the last 5 years? We need to look no further than the growth of our economy to figure this out, which actually shrank during the first quarter of this year. And another reminder that we remain mirrored in a weakest economic recovery since World War II. So Dodd-Franks has actually served to weaken our economy, not strengthen it, and the millions of Americans who have experienced a weak job market and decreased opportunity are the ones that are feeling the pain of Dodd-Franks. So, since 2011, the Financial Services Committee, under the chairmanship of Jeb Henseling from Texas, has led the charge to roll back some of the most damaging provision of Dodd-Franks. And I commend the chairman and all my colleagues on the committee for their continued effort in this regard. Unfortunately, it now appears that many of these efforts, which used to be bipartisan in nature, are running up against the rigid ideology which believes that Dodd-Franks was chiseled in stone some high place and should never be changed. I believe that their view is unsustainable as we continue to see of the harm that Dodd-Franks is inflicting upon American and hardworking Americans at that. So our committee and this Congress must continue to do the important work that will make it easier for our fellow citizens to get a job, obtain a credit card, obtain a mortgage, and create opportunities for themselves and their families. And with that,